Okay, let's dive right into this explainer. Today, we're totally exposing the highly guarded algorithmic secrets of the credit bureaus. Honestly, if you've ever felt like the rules of credit are intentionally designed to just keep you guessing, you are absolutely not alone. We're going to jump straight into the ultimate credit mix hack, specifically the heavyweight battle between installment loans and revolving credit. Because mastering this exact dynamic, it can completely transform your financial profile. To set the stage, meet our stickman hero. Honestly, he represents so many of us, right? He pays his bills perfectly on time, every single month, never misses a due date. Yet he's just sweating in total frustration because his credit score has completely flatlined. I mean, he's doing everything the traditional advice tells him to do. So, why isn't he seeing any return on his good financial behavior? Well, the answer actually often lies in a frequently ignored slice of the algorithmic pie. A slice that, seems kind of small but acts as a massive lever for your overall profile. We're talking about your credit mix, which makes up exactly 10% of your FICO score. Now, 10% might not sound like a huge deal at first glance, but when you're trying to break through a frustrating credit score plateau, this is often the exact tipping point that pushes you right into that exceptional tier. Just look at how these ingredients fit together in the FICO scoring model. Payment history absolutely dominates the chart at 35%. That's exactly why our stickman hero thought he was doing everything perfectly. And right behind that is the amount of debt, sitting heavily at 30%. But look down at that 10% credit mix. When your payment history is already flawless and your debt is low, that 10% is literally the missing puzzle piece for total credit optimization. Lenders want to see variety, They want proof that you can handle completely different types of financial pressure. So, let's break down those types. Revolving versus installment credit. To really master this 10%, we first need to clearly define the two main characters in our credit story. Pretty much every account on your credit report falls into one of two buckets. On one side, we have revolving credit, perfectly symbolized by your everyday credit card. This is a steady source of credit you can use, pay back, and use again repeatedly, meaning your balance fluctuates based on your spending. On the other side, we have installment loans. Think an auto loan or a 30-year mortgage. These are fixed amounts you borrow all at once, which you then pay down consistently in set monthly increments until the balance hits zero. And guess what? The algorithm treats these very differently. Which brings us to the FICO 10T shift, a totally new algorithm. Okay, here is where the plot thickens and the rules of the game fundamentally change. Just when you think you've got the algorithm figured out, the credit bureaus introduce a new antagonist for the unprepared borrower, the FICO 10T model. Now, to understand this shift, you kind of have to understand the past. Under older legacy systems like FICO Score 8, your score was literally just a point-in-time snapshot. It only cared about the present moment. If your credit utilization was 30% on the exact day the bank reported it to the bureau, well, that's simply what counted. It didn't matter if you were maxed out at 90% the month before or at zero the month after. It was just a single static photograph of your risk. But FICO 10T completely flips the script. That T actually stands for trended data. So instead of a single snapshot, the algorithm is now watching a full-blown movie of your financial life. FICO 10T tracks your historical behavior over at least the last 24 months. It really wants to know the trajectory of your debt. Are your balances steadily decreasing from 60% down to 30%, or have you just been hovering around 30% for 2 solid years? The trend is now just as important as the current number. Because of this 24-month memory, FICO 10T essentially places consumers into two distinct camps. First, it heavily penalizes revolvers. These are people who carry balances month to month and just pay the minimums. Conversely, the algorithm highly rewards transactors. Now, a transactor might use their credit lines heavily every single month, maybe even racking up thousands in expenses, but they actively pay their balances off entirely before the interest hits. Basically, trended data protects transactors from temporary score drops while punishing revolvers for long-term debt accumulation. All right, so how do we use this? Enter the credit mix hacks. The absolute crucial point here is figuring out how to engineer this evolving trended algorithm so it works for you. Our animated stickman, who is now acting as a very smart transactor, by the way, builds a dramatically stronger profile by combining account types. The data actually shows that combining revolving credit with an installment loan can raise your score significantly faster than using just credit cards alone. Why? Because it proves you can responsibly handle both the rigid discipline of fixed monthly loan payments and the unpredictable temptation of open credit lines. You're basically mastering both sides of the algorithmic coin. But a quick, super important word of caution before we get to the tactical steps. Remember that massive slice from our earlier pie chart? The amount of debt you owe drives a whopping 30% of your FICO score. So, while hacking the 10% credit mix is incredibly powerful, managing your overall credit utilization ratio across all these accounts is where the real digital wealth management happens. You absolutely cannot sacrifice your utilization just to get a better mix.
That leads us right into the AZO strategy. All zeros except one. Let's move to a highly tactical framework to manage that 30% utilization factor while still maintaining your perfect mix. In the world of credit optimization, there's this mathematically proven approach known as the AZEO method. The execution is simple, but it is incredibly precise. Step 1. Pay almost all of your revolving credit cards completely down to a $0 balance before their statement closing dates. Step 2. Leave exactly one card to report a balance. And Step 3. Ensure that single remaining balance is between 1% and 9% of that specific card's limit. By doing this, you engineer the absolute perfect credit utilization ratio, signaling incredibly low risk to those trended data models.
Now, you might be thinking, wait, why not just pay everything to zero? Isn't having zero debt reporting the ultimate goal? Actually, no way. If you report a 0% balance across literally all your cards, the algorithms will penalize you. It's called the zero utilization penalty. The system actually interprets total inactivity as higher risk or just a lack of current data. You have to show the algorithm that you are actively using and managing the tool, which is exactly why we aim for that 1 to 9% sweet spot on a single card. So, how do we handle the loan side? Let's look at fintech tools for alternative reporting. Okay, so you've optimized your revolving utilization with AZO, but what about the installment loan side of the hack? What if you really don't want to take out some massive, expensive car loan just to satisfy a computer algorithm? Well, the fintech world has completely stepped up with actual cheat codes for this exact purpose. You literally no longer need to go into debt to build credit. Tools like Self turn your locked savings into secured visas. Apps like Ava connect directly to your bank to report positive weekly payment trends. Kickoff offers low utilization trade lines alongside your everyday utility bills. And platforms like Cheers, they use AI-powered accelerated reporting to feed positive installment loan data directly to all three bureaus, without those massive interest rates. By leveraging these digital financial tools right from your smartphone, you can artificially engineer that perfect credit mix. Honestly, adding just one of these specialized credit builder installment loans to your revolving credit card strategy is a highly effective, super low-risk way to hack that 10% credit mix. You satisfy the algorithm's constant desire for variety, but without taking on the dangerous, unnecessary debt of a traditional personal loan. It's a total win-win. Ultimately, no matter what shifting FICO algorithm lenders decide to use, whether it's the legacy snapshot of FICO 8 or that deep 24-month memory of FICO 10T, there are universal boosters that will always protect your score. Pay on time every single time, because that is your 35% foundation. Keep your revolving utilization under 10% using that AZO method we talked about. Consistently pay down those installment loans. Avoid unnecessary debt consolidation that really just shuffles your money around. And always monitor multiple FICO versions before a major life purchase. As we wrap up this explainer, I want you to take a really hard look at your own digital wealth management. Are you a revolver just slowly bleeding out points month by month? Or are you a transactor optimizing the system? Take a look at your own portfolio. Is your credit engineered to beat the new trended data algorithms? Or are you going to be left behind still playing by the old rules? Think about how you'll adapt your mix before your next big move. Until next time, keep optimizing.